is not available online, only direct through this special 800 hotline we've set up for today's show. Just dial that number, 1-800-500-1390. One more time slowly, give us a call, 1-800-500-1390.
What's that?
Thanks so much for tuning into Purity Products Radio. We'll catch you next time.
The proceeding is a paid advertisement by Purity Products. These statements have not been evaluated by the Food and Drug Administration. This product is not intended to diagnose, treat, cure, or prevent any disease.
PGMA? What is that?
Oh, Charter.
No one gives a big warm hug like us when you need it. Come on, get in.
Can you type that in the chat?
Tell your smart device to play Real Radio 92.1 on iHeartRadio. What?
This
is WZZR FM, West Palm Beach, Real Radio 92.1, powered by the law offices of Anajar and Levine Accident Attorneys. Been in an accident? Call 1-800-747-FREE. That's 1-800-747-3733.
Gotcha.
Navigating today's real estate market can be tricky. Want to buy or sell a house, finance or insure a house, or stuck with a house and don't know what to do? Florida Talk Real Estate has been your local one-stop real estate shop since 2012. Get the advice you need from your local real estate pros. Here are your hosts, Jim DePola and Johnny C. live on Real Radio.
Yeah, Saturday morning. Great to have you with us every Saturday. It is time for 2 hours of infotainment. That's right, some information, hopefully some entertainment, and most valuable part of that really is the information part. And we got a team assembled every Saturday to give you all the information you need to keep you locked in to the market as it stands today on June 18th, I think, is this year's flying by. I'm your boy, Johnny C. Thank you for being with us on 92.1, 101.7, worldwide on your free download, your iHeartRadio app. And again, for those that are streaming with us on a Saturday, you can stream on Facebook and YouTube. You're going to look for Florida Talk Real Estate on Facebook, Florida Talk Real Estate LLC on YouTube. And on YouTube, there's a big hub of all kinds of informational videos for you to chunk out and watch, learn, and be entertained. Very good to have you with us. You can be a part of the show toll free at 877-927-6969. Jimothy will line you up, get you going. You make the call. We'll take that call here on a Saturday morning. Again, I'm your boy, Johnny C. Let's say good morning to Mike Rauch, the mortgage guy from the mortgage firm. Good morning, Michael. How are you, my friend?
I'm doing great this morning. Doing great. Happy Father's Day weekend to you, Johnny.
Well, you know, I'm a little disappointed you snuck it in, but I was hoping to be the first. But happy Father's Day weekend to you too, my friend.
I take it back.
No, okay, you can have it back. Yeah, you got big plans. We'll find out here in a second. Let's say good morning and happy Father's Day weekend. Jarrett Perry was joining us on a Saturday morning. That's Perry Group CPA. Not only is he a CPA, but he's a chartered global management accountant, ladies and gentlemen. Also with PPF, probably got it on his chest. I can't quite tell. But
always represent.
Oh, yeah. Players performance first, ladies and gentlemen.
Closet full of shirts.
I love it. My man, Jarrett, how are you, buddy?
I'm good. It's great to be here. I was hoping no one was going to say anything about Father's Day, so my wife may forget. And I could get – no, I'm just kidding. It's everywhere. How could you forget? They market it everywhere you go. It's marketed.
So, Jarrett, did I hear that properly? If she asked you, what do you want to do for Father's Day? You could never do what you actually want to do, which is probably go out fishing or just like
let's go sail fishing and dolphin fishing. And actually, she would go. She's a trooper. She would go with me or let me go by myself. One of those.
Oh, so you're going tomorrow then?
We went fishing on Father's Day together.
Oh, that's
Mike.
right. That's right. We did. Holy cow!
How could you're the one that asked that question?
Okay, so we're fishing.
That was
tomorrow.
last Father's Day.
That's right. Looks like we need to round up the crew again here, guys.
Let's go. It's fun. Tomorrow it's open. If you guys want to come, it's open to you guys. Let's go.
Although with gas prices these days, we might have to play hump or jump or something when we get out there to get some money. Jarrett, at least make it worth it. You know what I'm saying?
Yeah.
Mike, they're out there.
Well,
everyone's got to throw $50, but we can do it.
I would be down for just sitting on the boat, docked up, with an ice cooler, cooler full of beer, and we'll just fish right off the side of the boat.
I think that's because of your experience last time. maybe if I hadn't let Mike drive, he'd have a different attitude on it. We'll have to share that story some other time, but it ends up with me in the water, cutting lines off the propeller, limping in with one engine from.
Worried about sharks. Like, keep an eye out for sharks, guys.
Yeah.
So we won't bring that up. But if we're going fishing, we definitely got to include our guy Jimmy D, because it just won't be a Father's Day party without Jim DePola. It's been our fearless leader for many years here on the show now. And of course, I've always told you he runs a top producing Keller Williams team. That Keller Williams team is the Florida Home Pros with Keller Williams Innovations. Jimmy D, how you be?
Hey, I'm doing great. Happy Father's Day, guys. I hope you have a great Sunday tomorrow, and happy South Florida. Beautiful day out. Driving down here, the skies are nice and blue. I don't think there's going to be too much rain. I might be wrong about that. I thought I saw in the post that they said there was going to be some rain, but not right now. I've been driving from Palm Beach Gardens down to Boynton, and it's looking pretty clear
So far.
I feel like the more you pay attention to the rain thing, like the less you do, and the more I don't pay attention to it, the less rain there is. I know.
We've had a nice few days here with the rain not being too bad.
Everybody just stop for a second, if you don't mind. Anybody on Facebook listening to us right now? We are live on Facebook and on YouTube. Anybody on Facebook, if you could let us know if you can hear us, because I'm seeing a signal saying that our Facebook connection is down. So anybody on Facebook, if you could just type in something saying I'm here, we can hear you, that would be great. Okay. Happy Saturday to Francis and my mom and Susan, who just came in. Thank you so much. Thank you for supporting the show for so long, all you guys. We have so many people that we've helped over the years. And let me tell you, now is a great time. Okay, great. Thank you so much, Kasha. Kasha said that she can hear us on Facebook, so thank you so much. I love our audience when they help us out like that. Thank you so much. A lot of things are going on in the real estate, not the real estate market, the economy, okay? And the real estate market is just a component of the big picture right now. But we're going to be talking about basically the whole show. We're going to be talking a lot about the economy, maybe using some real life examples of people we're working with or had worked with in the past to show what's really happening now. Because if you're into anything, by the way, Elizabeth just chimed in. Thank you, Elizabeth, for coming back once again every week in, week out. Mike, she wished you a happy Father's Day yesterday on her Facebook page, and I forgot to mention that to you. So thank you so much.
Well, hi, Betty.
And
that's Elizabeth. That's Betty. She's.
I know. I'm sorry. I'm sorry, Betty. I always call you Elizabeth because I'm rushed when I'm doing this show, and I'm doing 10 things at one time, which I should not be doing. But anyway, there are a lot of changes going on in the economy in general and the real estate market. We've been focusing just on the real estate market component. So what have we been talking about? We've been talking about over the last year, we've been talking about the potential and then the reality of rising interest rates. We've been talking, maybe we've been at the peak. Remember, we used to talk about Mount Everest and being at the snow caps.
Or the ball analogy, right? The ball analogy.
I'm sorry. Yep. The ball analogy where you were thrown up. We talked about defying gravity, the markets that the economists predict was going to defy gravity. Do you remember that? That was interest rates were going up, but the economists said, but don't worry, the prices are going to go up too. And that was called defying gravity, right? What goes up must go up.
Is that the stagflation also, right, Jim?
Talked about stagflation. I've been talking about that since 2018, guys. If it wasn't for COVID, we probably already would have had it already. If it wasn't for COVID, we probably would have had that stagflation. I'll get into that a little bit today. We're going to talk about stats and little cracks, fissures that are showing up in this bull market that we've had in real estate and stocks. I was just listening to a podcast yesterday for Ezra Klein. He's a good guy used to be on NPR. I don't know if he's still on NPR. I think he's at the New York Times now. But he had an economist on who said that for the last 10 years, we've been in, this is interesting, an everything bubble. And I was like, wow, that's kind of an interesting concept. So I listened to the hour-long podcast about everything bubble and trying to understand that. We're going to talk about that today, because it shows how everything's interconnected. So we're going through a very big interconnection time right now. We're going to get into that.
I like that as a prediction. Everything is going to burst, and then when something bursts, you'll be like, "I called it."
Told
I
you.
called it.
Yeah.
And if only one thing goes, you're like, that's first domino. Just hold on.
Yeah.
Yeah.
I predict that prices are going to go up or down or stay flat. That's what I predict.
Yeah.
Good one.
You're going to be on
And
the
I don't know
you know.
when it's going to happen, but it's going to happen.
Yeah, it's going to happen. It's going to go up, down, or stay flat. I guarantee you that. And then, I'm so glad that we have Jarrett on the show today. Jarrett's one of my favorite guests. And of course, we're business partners for Player Performance First. Jarrett's represented with the shirt today. I almost wore mine, but I have a listing appointment after this. But
I almost wore mine, but I don't have one.
You don't have
Johnny,
one yet.
you know what? I'm sending an email right now, so I remember to mail you and Mike.
Wait a second, Jim. So you had, like, this morning, you were deciding, do I wear my PPF T-shirt or do I wear the shirt that you're wearing right now? And that shirt won somehow?
Yes, because this is my 60s shirt. For some reason, I feel like I want to be in the 60s lately. So this is my psychedelic flower shirt. So I wear that. So I figured that Mike would be the one that would make fun of my shirt. Because when I was putting it on today, I go, somebody's going to say something about the shirt.
One of the, if you're a radio listener, you know what we're talking about. One of the benefits of watching us live on YouTube or Facebook is that you get to see Jimmy's wardrobe. So.
Oh yeah, Mr. Connoisseur for wardrobe.
Hey, you guys text me your sizes. I already sent an email, so I'll get them.
And Jarrett, I need smaller T-shirts. I've lost so much weight. I need smaller T-shirts for real. They're way too big.
They're just if you the next time you're at the office, you just open the drawer and grab them.
Okay, I'm going to do that next time. Okay, and I just wanted to talk to people. While we're going through all the stuff that we're going to go through, and let me tell you, we're going to be going through some stuff on this show. We started this show in 2012, 10 years ago. January 7th, it was 10 years ago. We started this show, and 12 years ago, we were still going down. We were still going down in the market. We were not finished sliding yet. The slide, of course, started in 2006 for Florida. For most of the rest of the country, it's 2008. But in Florida, it was 2006. And we were down for 6 years, right? Now, we're in a 10-year bull market. I learned yesterday, according to economists, that the average long bull market, the longest bull market before this was 5 years.
For real estate?
No, for everything.
Everything.
Okay, not just for real estate. Yes, thank you for clarifying that. Bull market. Well, let me think about that because I only listened to it last night. Bull market for the stock market, let's say. Okay, I don't want to exaggerate. So I know confidently I could say stock market. I don't know if she meant everything, like the everything. Okay, but the argument this economist made, and she did the podcast about a year ago talking about the everything bubble, that we were in an everything bubble. And that's why Ezra Klein brought her back now to talk about.
You sure she wasn't saying everything bagel?
No, everything bubble. I promise. And that's why they brought her back this week to talk about, is this everything bubble going to pop? And her answer is it's already popped. She feels that we're already started the recession and that when we look backwards, and that's usually when you find out, just like any peak or any valley, you don't find out where you are until you look backwards with these kind of statistics. You don't know while you're in it what's happening. Might have a feel, but you don't know until it happens. So, for example, let's talk about a good thing. Remember when everybody thought that the economy was just going to totally crash forever when COVID hit, and we had the most massive unemployment at one time ever, and nobody was working, and this is before we started feeding everybody money to make everything okay. Before that, everybody thought the market was completely going to crash and they were going to go into a depression, not a recession. And of course, that didn't happen. And everybody was surprised. Everybody's like, wow. And everybody thought the real estate market was going to die, and it didn't. Everybody's like, wow, it grew. And then we had the traveling. Everybody thought travel would die for a long time. And as soon as everybody got to trying to travel last year, boom. It just exploded with demand. So
Airbnbs went crazy.
We're going to get into that. I just didn't want to get into that one right now. But yeah, we're going to talk a little bit about the real estate market, about some of the fissures that are happening right now. Let's talk a little bit about that. Well, getting back to the show. So we've been doing this show for 10 years. When we started this show, Johnny, you know what? I never told this on the air, but I'm going to go ahead and say it today. The first time we were on the show, the first year on the show, we went on the show 52 weeks. We did not miss one day, right? We did not miss 1 week, thank God, back then. And we booked 51 listings back then. Now, the average realtor back then was the average first-year realtor, which I was when I started the show, does about 6 transactions a year at that time, back in 2012. And I had booked 51 listings my first year. But they were 51 short sales. I did not get one regular listing my first year as a realtor. I had to get into the fire pit without any flame retardant clothing and try to walk out. So walk out of it unscathed. And, you know, we learned how to be top real estate agents by working with people that were in desperate situations with their houses and fighting the banks for the good fight for the families that were trying to either save their house or sell their house without having lifetime economic damage to their future. And that's what we were doing. And we were giving the best advice out there. There was nobody out there, nobody back then. And they had live TV shows. Remember that? They used to do the live TV shows and break into prime time television to do these live events where you could call hotlines and talk to attorneys and mortgage brokers and realtors to try to help you out. We were part of that thanks to the law office of Paola Krasker, which was one of the best law firms to go to when you were in trouble with your house, because they weren't there just to do a bankruptcy or, you know, just to fight the foreclosure and keep you in your house and then screw your life up forever and ever to keep a house that was so upside down you shouldn't keep it anyway. Right. They were out there helping it. So were we. Mike, you were going to say,
do you remember at that time, like how many of the homes that are sold in that time, how many of them were not short sales? Was it like 50%?
I do know.
Was it 90%?
I do know it's 40%. 60% of the houses were either single family homes, were either short sales or foreclosure back then. 6 out of 10. That's Yikes. Crazy town. What is it right now? Less than 1%.
Wow.
Okay, so just to put it in perspective. Okay, so
which is hard to believe. Which is hard to believe that we're involved with any kind of popping when we're talking about the real estate market.
Yeah, exactly. But we're seeing it, and I'm gonna talk about that in just a little bit. So our show was built to help people get the advice that they needed at the time that they needed it. You know what? People don't even realize it, but they need that advice now more than ever. There's so much stuff going on that if you make the wrong decision, it can cost you years of financial headache and consideration. So let me give you an example of a couple. And I'm so happy. I have a big smile on my face. If you can't hear it, see it on the radio. Okay, I got a big smile right now because I love these phone calls. I got 2 awesome phone calls this week from people I haven't talked to in over, well, one of them I haven't talked to since 2014.
Wow.
Okay. And the other one I haven't talked to since 2021. And Mike, you're part of that one. So I'm going to go to that one first.
You're the opposite of me. If I got a call from somebody from 2014 that I haven't talked to, I would never answer it.
That's so funny.
There's no way you could pay me to answer that call. There's no way.
That's so funny. So I get a call. I get a call from the 888 number, which is 24/7 888. 888-973-7828. I thought I was giving out the live number.
Nope.
And Eric called that number after many years, and he called me up, and it made my day. He and Jessica have been big fans of the show. They might even be listening now, and I had no idea they've been listening all these years. But they called us up, and they owned a house up in Palm Beach Gardens, nice home, and they were wondering whether they should refi the house or not. And figured out ways to pay off the house the best way. They talked to Mike. Mike gave them really great advice about the best way to pay down the mortgage. I think it wasn't with, I think you told them not to do the refi. And the reason why I'm saying that is because they right now have a 3.12% interest rate. Now, in January, it was like, okay, so you got 3.12 interest rate, big deal. But today, it's like, oh my gosh, that's like half of what people are paying right now, right? Yeah. So he called us up today. He called us up this week and he said, Jim, you guys gave us such great advice on our house. We're so financially set where we are right now in our house. We love our house, but we really want to do some upgrades to the house. It's getting older. And we only owe like, I'm making up fake numbers here, but they owe, well, let's just say that the house is worth $1 million. Okay. And they owe less than 10% of that. So they owe less than $100,000 and they have the money just to pay off the mortgage, or they could take the money and put it into the house.
Or keep their actual cash and try to find a way to maybe access some other cash. Is that another option?
Well, they were wondering, one of the questions they have, should I do like a cash out refi and then keep the money in my pocket and everything? And Mike's already, if you're on YouTube or Facebook, you're seeing Mike's answer already with his head movements. And I agree with Mike 100%. So it's so cool how we all think the same. Because I was doing the same thing. I was shaking my head. I'm sorry, Jarrett, what?
I was saying if they had like an investment portfolio, they don't have to sell the stocks. They can actually take a line against the stocks, their assets. So there's
didn't even know that. I should have had to talk to Jarrett too.
Athletes buy their houses by using the collateralized asset to get the money if they can get a better rate.
Sure. Are you loan against your 401k?
You cannot use your 401k.
No, you can't.
Yeah, I mean, typically you
different plans. Every 401k is different. The NFL plan, I don't think they can, but on other employer plans, you may be able to. And if you could roll it out into an IRA and probably use it.
I want to go back to that, guys. Let me go back to that because that's really good. That's a good savings technique that we're going to talk about with Mike. So keep that. I promise we're going to get back to that. But what happened with Eric is that what I explained to him is that he has a Willy Wonka golden ticket interest rate right now at 3.11%. And it's so cheap. He's borrowing that roughly $100,000 so cheap right now that if he were to do the cash out refi, he would not be getting 3.1%. Right, Mike?
That's correct.
So he would be borrowing at a higher price than he's paying now for the mortgage. So I told him, if you're really going to do the renovations with your cash out of pocket instead of dipping into and like cracking that mortgage that you have this great interest rate with.
But it's not even just the extra amount. If he's doing a refi, he's taking his old amount and making that subject to a higher rate. And he's resetting the whole amortization schedule, right, Mike?
Yeah, I mean, so the other investment like strategies are getting cash. If the question is how do you tap into the equity position of your home, you have two options. You can either do a cash out refinance, which would do what Jarrett just said, which is replace your existing loan with the new loan, or the other option is a home equity style product, right? A home equity loan or home equity line of credit, where you leave your existing loan in place and then you get a second loan at whatever the current market is. And so that's what I would, if we're saying, how do you access the equity? You can either sell it, you can cash out refi, or you can do a home equity product. And so I would certainly encourage a home equity product because you don't want to replace that 100,000 at 3% with that's something at 6%, right? It doesn't for 5.5%.
Exactly. It just doesn't make financial sense. And let me tell you, I'm not saying everybody would do this, but there's a lot of mortgage brokers out there or loan officers that will try to convince you to go ahead and do that. Oh, sure, you have so much equity, just do this, but you're not looking at the big picture. And now it's so hard to get the business of being in the mortgage industry right now. It's a little tough.
Yeah.
So you're going to get a lot more people that are going to tell you what's good for them and not good for you. And that's what makes us.
Jim, a lot of people in my position. So I can't do a home equity loan, right? That's not the where in my world. And so of course I would push a product that I could do. And I might even tell you, not me, of course, but somebody in my position, the loan originator might say, hey, yeah, you could do it at 3%, right? It's going to cost you $20,000 in points, right? We're going to eat into your equity position to pay that fee. But sure, if you wanted 3%, you could do that, right? Yes, it can be done. And yes, it could be made to look, if you squint your eyes, like an attractive choice. but it's not in reality.
Mike, I've been meaning to tell you, I got one of those things in the mail that said like, hey, there's all these new government programs. Like if you've been consistent making your loan payments for the past, 12 months, you should call in because you should qualify for some government program. And I'm like, I know this has to be a scam, but I have my clients that ask me about this stuff all the time. So I'm going to call and see what happens. Right.
Oh, cool.
So I called the number. I was like on a Saturday, and I was sitting at the house and I just called him. And the guy seemed somewhat intelligent, but what he was selling me on was a product I was going to have to do to get the cash out. There's no government program. He never even mentioned a government program at all. Not even once did that even come up. He was like, oh, you got equity in your house? What's it worth? And I was giving him round numbers. And I'm like, where's this going? And then he's like, you can refinance and it would be whatever it was, almost 6% or something. And, my whole loan. And he was trying to convince me that it made sense. And I said, man, I'm a CPA. I understand how everything works, and there's no way this makes sense at all.
Right?
And is there any government program that that's what I was calling about? And he's like, I don't know of any government program.
The advertisement didn't say which government.
Yeah,
it's just a government program.
Devil is always in the details. We're giving you really good examples right here why you need to have trusted sources and people that you're getting great information from. Florida Talk Real Estate is a .com. We call it your one-stop real estate shop for a reason. You have access to the entire team, guys like Jim DePola, Jarrett Perry, Mike Rauch. We're talking specifically about accessing equity in your home and what your best decision is. I remember prior to a cash out refi that me and my family did, for the longest time, Mike kept telling us your best option is a HELOC. And again, I don't know if you heard his words. He cannot service you for that. He's sending me somewhere else. That was my best option based on my numbers and his expertise. Things changed eventually, and we did a cash out refi. You need to be with people that are not only good at what they do, but great at what they do. Every situation is like a snowflake, and you need to get that information so you can make the best decision for you and your family moving forward. Florida, talkrealestate.com or call 888-973-7828. That's 24 hours a day, 7 days a week, answered by a live body. You'll find the hotline at floridatalkrealestate.com. Let me just give a great example real quick. Snowflake. Here we go. I got a buddy, Mike. You're gonna think of him immediately. I got a buddy that I know has worked with Mike. He shared with me some details. They were in a pretty good position with their home, and they were looking to pay off some debt and access some cash, do some improvements on the home. I guess from what he explained to me, he actually had to maneuver a little bit with some dollars, buy some points to position themselves. But through your expertise, he got all his numbers in place. They're going to be doing really well, even in today's market with the rate they're getting. Going to be doing really well with their future plan, and that's a value in going to people that are good at what they do and lay it out for you. You laid it out for them, and they said that's going to work. And let's go ahead and get.
What they bought down the interest rate or something, Mike?
Just a little bit, yeah. To get
I'll just say it like this. So there's always going to be. When you have a refi conversation, and so Johnny, I think you said that in the previous weeks, refis have pretty much died out, and so the ones that you're looking at are really kind of like the debt consolidation style.
Sure.
That's the motivation. I want to consolidate debt. Our budget's really tight. I want to be able to free up some of our income towards this other stuff and maybe do home improvements, whatever it is. And so it's always about what's the major motivation. And if the answer to the question is, listen, I just really need to get into this equity. I don't want to do kind of an adjustable rate or maybe a little bit more they're looking for long-term fixed rate and let's make it as painless as possible on the payment. Right. And so when that's the motivation, then you basically say here, yes, we can do this. And here's the best situation. Here's what I think as far as rates go. If you're paying points, I think that's a good decision. What's the break even? And that's the type of. But yeah, I know who you're talking about, and we had conversations, and I said, "Hey, here's what it's going to look like. Why don't you guys talk it over? Tell me what you think."
Sure.
I think we're checking the boxes of does this make sense for the motivation of your refi? If you just wanted to get a lower payment, right? like not get cash out, not tap into the equity, then of course it's never going to make sense.
No,
Right, so
financial positioning on
Yeah.
a monthly basis it makes a ton of sense for them
Yeah.
because they free up a bunch of cash. And again, they're going higher interest, they're paying lower interest now. Like you laid it all out and it made sense. And on paper, like when you just say, hey, this is what I'm going to do, you go, oh, really? That doesn't seem like it's going to work. But when it's all really laid out and explained to you and the
Yep.
numbers all matter, it's all dollars and cents. It's like, oh, well, I'm glad you did that. And they locked in prior to the Fed raising, and I mean, they did
awesome.
well with their
Just-
time and all things.
I got somebody on IG that's been asking what are points. So, Mike, if you want to maybe just let them know exactly
Okay.
what that means.
Yes. So basically, there's a concept of when it comes to interest rates of a par rate. So the par rate, kind of like the golf analogy, means it's zero. It doesn't cost you any money for that specific rate. It also doesn't pay you any money, right? There's no credit.
Meaning
There's
to get a loan with that rate, right?
Yeah, let's say the par rate was 6%, right? I'll just use that as a par. So if you said, well, gee, I don't like 6%, I want 5.5%. I say, okay, you can have 5.5%, but you pay points, as in a percentage point of the loan amount. So 1% equals 1 point to buy down the rate a certain amount. Now you're not going to paying 1% does not buy it from 6 to 5, right? It probably buys it from 6 to 5.75, right? Or 5.875, something like that. So it's not like a 1-to-1 ratio, but essentially the idea is you can pay money to get a lower rate. And then the math that you should be doing in your head or with your loan originator is, okay, if I get the lower rate, how much does that reduce my monthly payment? How long am I in the red on that decision, right?
Yeah,
So if it costs me $1,000 and my payment is lower by $25, how long until I recover that $1,000? And then after that recovery point or that break even point, the longer you have that loan, the more sense it made to buy down that rate. So
And
you might have
like 3 years or so, right, Mike? Roughly.
Yeah, I mean, it really depends, but I don't like a break even longer than say 4 years. For me, that becomes a little bit iffy, just because, like, some people say, listen, we're not going anywhere. We're going to have this house forever. In that case, okay. But for a lot of people, life happens, right? And so a lot can happen in 4 or 5 years, and so you just kind of have to weigh the benefit. How much are you reducing your payment? How long is the break even? So. But
points, I think a lot of people have a perception that when you pay points, those are going to the broker. Those are fees that the person they're working with is getting paid extra. So I think it'd be good to kind of highlight, like, maybe how you get paid so they know that that's not what you're getting paid.
It's funny you bring that up, Jarrett, because I actually had that conversation recently where someone was saying, "Oh my God, look at the points on this rate. Is that your commission or whatever?" So I'll just say, in my position I work for a direct lender. I'm a loan originator. I'm not a broker. My compensation has absolutely nothing to do with what rate you end up with, what rate you're buying with points or whatever, right? So my compensation is based ultimately on the loan amount. Whether you get 5%, 6%, 7%, it doesn't change how I'm compensated. So the points that you're paying is all about, do you want to pay money to get the lower rate and lower your payment?
My question is, Mike, if you were a mortgage broker, and the difference between a broker and a loan officer, which Mike is a loan officer, he works for one lender.
Right.
And the lender, like the underwriting department, everything is connected to the mortgage firm where Mike works. A mortgage broker, and most people don't understand this, they don't really work for any lender. They have a pool of lenders that their company works with, and they shop your loan to a bunch of different lenders to see who will give them, quote, the best situation. Now, sometimes, for what I've found out, is the best situation isn't always the best situation for the customer. Sometimes mortgage brokers will go to a company that might be offering some kind of extra benefit for securing the loan with them. Is that true? Like sometimes mortgage brokers get like.
You're saying?
I'm sorry?
They get paid a higher commission for closing it with a different company?
Some companies will offer benefits saying, hey, if you give us the business with these terms, with these certain terms, like if you have somebody that's willing to buy down points, we'll give you some of that.
For the point. Yeah.
We'll give you some of those points. If they buy down to the point, we'll give you some of that.
Yeah.
Yeah, it used to be before I was in this business, but there's a concept called a yield spread premium, right? Or YSP.
Okay. Mm-hmm.
And so it used to be that whether you're a direct lender or a broker or whatever, the loan originator could adjust his compensation on an individual customer or loan basis, right? And so that was one of the things that led up to, I guess when some greediness, right, in the market at the time, where it's like, hey, let me put you into this exotic product because look at the yield spread on this product, right? This interest only 10-year interest only payment has a huge upside for the loan originator, right? Not for the consumer, but for the loan originator. And so they redid a lot of that with the TRID rules, and like when they made these laws to try and kind of fix that area where there could be, malfeasance, I guess, right, or just greed, I guess, on the part of the originator. So they changed that up. Brokers, within reason, still have kind of some of that flexibility, right, where they can maybe take less on an individual or take more on another individual loan. And so sometimes that can work for you.
Complexity of the tax return, like if you're doing my tax return, it's a nightmare, or you're doing a W-2 person, does the amount that you get paid vary?
No. Not me. So
crazy.
Yeah, I think the ultimately, if you can find somebody who knows what they're doing and the rate is better and it's not going to be a headache and you're not going to have, there's, Jim, one of the advantages to working with the mortgage firm in particular, but a direct lender generally, is that everything is in-house, right? So I could get on the phone with the head of the underwriting department in a second and talk through a problem if I had that, right? So I'm very I'm involved in the loan process from
it doesn't work like that
beginning to end. Brokers really don't have any of that control. They're basically sending the loan to an underwriting department halfway across the country, and then they get back and whatever. If you're easy, you can get it done. If you got any complications, sometimes it can be a major headache.
Yeah, and again, to highlight how beautiful that is, again, for all direct lenders, mortgage firm particularly, Mike can pick up the phone and be talking to the underwriting department, and every situation is like a snowflake. So if there's this really quirky aspect to your application, Mike can walk them through, versus where if they're just looking at it, they go, no, I can't do that. Mike can explain it and get through the pitfalls, and if there is a way, that's a huge benefit.
This is funny. Just right here on this panel right now, I've done loans for all three people, and Timothy, I haven't done a loan for, but I directed him and said, hey, HELOC is something that you should be looking at. But Jarrett, you need a special level of expertise in order to do loans for Jarrett, right?
So true.
That's just Jim is self-employed. Right. No, Jim is self-employed as a real estate agent. Jim needs a special level of expertise. Johnny sees the easiest of all you guys. What he needed was the expertise about timing and whether it was right or not. So it's you have to have somebody in my position who's really looking at all those angles and can be able to perform. Jarrett is just I'm telling you, Jarrett, how many people tried to do a loan for you before you got to me?
I think they all kind of gave up when I started sending them all my tax returns for the year. Once they got so many tax returns, they were just and they didn't ask the right questions, about the depreciation. I was just I can't spend my time, so I didn't go to many people.
It's almost unfair because there's people loan originators aren't really meant to understand tax returns at a complicated level like Jarrett's, where you have multiple businesses and different structures and multiple owners and everything. And so I just happen to kind of like that stuff, and so I've made some effort. And I even had to go to Jarrett. I remember at the time we had to go to the head of the underwriting department and explain something, because they weren't seeing it. Luckily, that guy was a CPA in his former life. Jarrett spoke the same language. I kind of acted as a mediator, and we got the thing done. And Jarrett was right, of course. We just had to make my guy see it, and we did, and we were able to. There's a major difference.
I think a lot of this, Jim, when we start talking about the economy and what's coming up, is going to be interesting, because the loans have become very difficult for small business owners to get. And, even lines of credit or credit cards. They used to give you 50 grand if you're in certain types of businesses, or 25,000 on a credit card, $100,000 line of credit for new businesses at one point, or if you'd been in business a year, you could get that stuff. Now you're lucky if you get half of that, if you've been in business 10 years, so there was a ton of lending last year that came out with the SBA, and a lot of it was forgiven and a lot of it wasn't. And, that's going to be a major problem now because they're not going to have access to loans like that, like as easy as it was to get these prior loans.
Well, let's get into that a little bit, Jarrett. The businesses, you interview with a lot of business owners like me, right? That you have to do the taxes at the end of the year and talk about what's happening in the future. And you had kind of just mentioned, we're not going to get anybody specific, of course, but you had mentioned to me a couple of times when we've talked that it's a little spooky, kind of a little scary what you're seeing when you're talking to these business owners and thinking about how economically what's going to happen in the future.
Yeah.
What were the biggest concerns or comments or obstacles that you saw the business owners talking about? Because you know what? People don't understand this, but small business is the backbone of this country. It is not the big corporations. The great vast majority of people employed are employed by small businesses, not the big companies, not the Teslas and General Foods or whatever. I don't even know if General Foods still exists anymore. It's old. But these big conglomerations, we're talking about little mom and pop shops,
Well, and I think even, the employment's a big issue as well, because, they say they have all these people that want to work, but I'm hearing the same thing from all the business owners. Yeah, you can get 1,000 resumes or whatever it is that you want. Everybody's got a resume out there. But you hire the people, and I have my own experience with this multiple times as well. You get them in there and they can't do what they said they can do, nor do they want to work anything like past whatever a normal job routine is to kind of get to that next level like I did when I was going through my career. And so it's hard for us to relate to that mindset, I think, as an employer. And I think that's a major problem for businesses to be able to grow when there's been such a drastic change in the generations and their mindsets on work and monetary items and all that type of stuff. But like you said, Jim, I think a lot of the businesses, were becoming accustomed to, we had this major change when COVID hit, right? So everyone was set for the economy busting at first. And then the SBA, next thing you know, was like, listen, guys, we got you. We're going to give you this PPP loan. And if you can't qualify for that, there's every city and county has grants and stuff available for certain business sectors. And, that's one of the things I've been learning a lot this year is how many loans, and even last year when I did taxes, and grants were out there that people were getting that I didn't even know about. You just had to go look. So the PPP they got a nice chunk of money for that. And it was supposed to be to pay people that are at home, not able to work during COVID, right? And that's what I used mine for. I can say that freely because I know I did. My staff was at home when they weren't able to come to the office and they got a paycheck. Not everybody did that. And then they came out with the the EIDL loan, right? Which basically said, hey, if you can send us a couple years of tax returns that shows you had a decent amount of income, then we're pretty much satisfied that, you may have had some economic disaster as a result, or may potentially have some economic disaster as a result of COVID, so it was basically you get an email and there's a lever bar and it starts at 0 and you can just drag it. How much do you want your loan to be? Everyone that's done an SBA and EIDL loan, this is what you drag the lever, you go from 0 and it goes for most people, it would go from 0 to $1 million. And if it goes over 250, you have to personally guarantee it. So a lot of the people, the money was supposed to be used to be dumped back into the business as operating capital for operating expenses. And although there's a lot of people that did that, there's a lot of people that took the money and used it for other things. And it didn't just stop there, because then after that, they came out with another PPP that they forgave both. So nobody has to pay back either one. And then they gave everybody the option to apply for reconsideration to have their loan amount increased basically from 0 to another million, you know? And so I think businesses have been appearing very strong, and business owners feel, small business owners especially, because that's a lot of money for a small business owner. And you're getting, you know, $100,000 for your employees, and you don't have to pay it back, and you're still paying them the same way you paid them before, you know? So not saying everybody did that, but a lot of people were. So they had an extra influx of income. And I think they got accustomed to maybe not having to work as hard as they were prior to COVID. And now that COVID's kind of, you know, people want to move past it regardless of the state of it. I just got my butt kicked by it, so I'm not going to say it's over with, but because it literally kicked my butt. But, you know, people are getting back into the real world and having to realize, like, hey, there's not all this money that I thought I had that I could just spend everywhere I go. I could spend money or fix up my house or buy a boat or not have to work that hard. And I think that combined with the employment issue is going to cause some major, and I'm hearing it from the business owners, like Jim said. I mean, they're coming in and saying they're having cash flow problems.
So that's like little canary in a coal mine number one. Okay.
Yeah,
Here's
boots
some
on the ground. Like, what are the small business owners thinking about, right? Like that as an indicator of that. Correct me if I'm wrong, Jim or Jarrett, but the EIDL loans, they were deferred for a year initially, then they had another year on top of that. Has that been extended again, or are these loans? Does the repayment phase on those loans start up here pretty quickly?
No, I think if you applied for reconsideration, you reset that period. So like, and they may have actually granted I thought it was 36 months, to be honest with you.
Okay, so the business owners who borrowed the money at great rates, right?
Don't hold me to that. I mean, it could be low, but I'm pretty sure it's either 24 or 36. You know?
And Jarrett, let me ask you, for the business owners that you're speaking of,
they haven't even started paying that yet. You know, they haven't even started making these EIDL payments. So that part of the cash flow problem hasn't even kicked in yet.
Yeah, so for these people, is their cash flow issue? Is it because their business is down, their overhead's up? Is it a combination of both? Like, what's the problem for them ultimately? Because I
think it's a number of different
business is getting back to about where it was.
Yeah, I think it's a number of different things, but I think what it leads down to ultimately is that they were subsidizing the loss of income with this money that they had from the loans, because, you know, instead of carrying a $50,000 bank balance, now they're carrying a $200,000 balance because they got a $150,000 loan. So they can spend that $150,000 and look at their bank balance and think they're doing okay. They're not thinking of it as, I'm losing money every time I have to use money from the loan. You know what I mean? And I think they're just getting by in the day to day, because if they looked at their actual financials, and that's the problem. Most business owners, they don't do like a monthly bank reconciliation and look at their P&L every month and go over it. They don't want to, it's an expensive service to have that and sit down with the CPA every month and do that. So they do it annually, right? They'll wait and do it all at once, and then we'll go over everything. Sometimes we do it quarterly. It just depends on what they're willing to spend and how we can work it in. But the ones that waited and did it annually, or didn't let me know, or didn't have any sense of it, when we do their books, they're going to see, and they are seeing, that they had a loss, and it's all starting to kind of make sense to them. You know,
they were actually losing money.
I thought I was living a great life last year.
Yeah,
and it's like, well, you started out with $150,000 in the bank, but then, you know, but 100 of it was a loan, and it's all gone. You know, so
talking to the small business owners, I know it's kind of like that. So, like, let's say that they were making a decent salary after they paid, or income after they paid all their business expenses, including salaries of other people. But let's say that they had a carrying balance of $50,000 in the bank at every month after they were done with everything. And now all of a sudden they got $250,000 in the bank. So they feel like they're rich, but really they might still be only doing that $50,000, you know, net balance at the end of every month, but they got this extra 200. So then they start spending more money, and then their income hasn't really grown to make up the difference of that. And over the long run, it can catch up with you, and you can get
John,
caught.
if they were looking at it more
So
frequently,
America, live above your means, America. Yes.
if they were looking at it more frequently, they would be able to see it, and somebody would be able to explain it to them. But typically, most business owners aren't doing that.
Well, here are some other signs. Okay, we talked last week, I think, Mike, that the mortgage industry, of course, is just sloughing off positions right now because there's less refis. Right? Why are you going to refi if you got a mortgage in the last 3.5, 4 years? You're probably doing much better than what you can get today. Most of the people, right? So unless you're doing the cash out refi, which some people need to do, and then there's a reason to do this, you have way less people involved in that. Also, a lot of purchasers are being pushed out of the market. It was funny. I'm in a group for the Sun Sentinel retirees group on Facebook. So you have all these grizzled former retired journalists from all over South Florida in this Facebook group, this private Facebook group. And I saw one of the journalists say, "Oh my God, the New York Post put in that mortgage rates are soaring," right? She didn't like the word soaring. She goes, "When I bought my first home in 1980, whatever, I paid 13%. This isn't soaring. These articles are blowing everything out of proportion." So I couldn't let it go.
Yeah, you're like, lady,
I should have just let it go.
6.5 to 13%.
So I sent a message. Out, and I'm really sticking my neck out because there's there's a bunch of reporters there, all these reporters there, right? And I'm sticking my neck out. And I go, well, I think that most people trying to buy a house right now would say not only is the mortgage rate soaring, but they'd probably add an F-bomb in front of the word soaring, right? From their perspective, I said every time that the interest rates go up a full point, they lose 10% of their purchase power. We started in January at 3.11, and today we're at 5.78, guys, 2.5 points higher. So now people have lost 25% of their purchase power to keep the same mortgage payment. They would have to buy a house 25% less than they could have in January. Now, don't tell me that isn't mortgage rate soaring.
Right.
Don't tell me about 1983. I don't want to hear about 1983, although I think we're heading there. Okay, I think we're heading backwards.
The difference is she didn't 6 months prior to her locking in a 13%.
Yeah, she knew what the rate
6.5%. It didn't double in 6 months. So
exactly.
She's gotta really pay attention to all the details.
Exactly. It's so, and it just shows you perceptions of how people are looking at this stuff, and they're not looking at it right. They don't understand what's really going on here. It's easy to carp about, I paid 18% because in 1983 you were paying 18%. Okay.
But on top of that, there's been insurance hikes. Like, I know there was a huge. I got dropped from my carrier, and they increased my insurance for over $4,000.
Yep, I heard another company just dumped. The 7th one just left. Ross isn't here today, but he sent me a text. It took him 4 days to respond to me. Ross is never like that, and he sent me a message that was so short. And I was like, this guy just beat up. So I didn't respond to him. I felt bad for Ross right now.
Probably all those people,
But getting back to the perspective of what's happening. So now we have all these mortgage people being laid off, right?
Hey,
servicers, underwriters, mortgage brokers, loan officers. Go ahead, Mike.
I just wanted to say on that point that you just made about the 1%. And so at 25%, what that means for people, put in perspective. If in January you were shopping and you qualified for a $400,000 home, you now have to find that same home at $300,000 in order to buy it.
And in order to make,
that is the part that has not happened, right?
Well,
Interest
that's
rates
coming.
have come up. Prices
coming.
have not come down, not even
but
close
they are.
to 25%.
But they are. You'll see next month. Okay,
yeah, sure.
I promise you next
coming.
month we're going to see it. Okay, so here's a couple other things. It isn't just
come down 100,000 next month.
No. But it's coming down. It's coming down though. Well, you got to start somewhere, Johnny.
Yeah,
you got to start somewhere. So
is that including waterfront?
If we lose 100,000 in 1 month, that's worse than the financial crisis we had last time.
Yeah, exactly.
That's how bad it would be.
And the only reason they're gonna come down is because the sellers have to sell, right? I mean, that's the only reason. If they stay in that home, they don't have to sell. They're not dropping their price, right?
It depends. It depends. It
No,
depends.
are we talking about?
No, I don't agree with that at all. So I'm meeting with a couple right now. They're thinking of selling their house. They have a choice. They're thinking of moving out of state. So they want to sell the house. It isn't they have to sell. They have a ton of equity in the house, but they feel it's at a peak. Let's go ahead and sell.
Okay,
And
so
but they don't have to.
Their debate is going to be this nice big chunk of equity right now, or rent it at whatever their rate is going to be. You got carry costs. I mean, so it's going to be a numbers game for them, right? Ultimately,
but that's a choice. It isn't a forced. It isn't a forced thing.
True.
There's a lot of people out there that have a ton of equity right now, which was different than the other time.
Yeah, that's
still
true.
a ton of equity.
If you're in a position where you're not forced, that's beautiful.
Well, I just want to let me just get over a couple of these other fissures we're seeing. Okay, guys, just real quick. So now we're in the real estate market. So the week after the mortgage companies were announcing all these layoffs, now the real estate companies are doing that, right? Redfin and Compass, which are kind of two of the bigger companies. They're not really big compared to Keller Williams or Remax, for example, but they got a little chunk of the market. First of all, Compass, their stock, forget about it. Their stock just got crushed. Anybody that's a publicly traded for real estate market right now, that's a real estate company, they're getting crushed in the stock market. And they're going to start getting crushed in the real estate market. So let me see. Compass announced that 10% of its workforce is being cut out. Redfin is announcing 8% cut. Now, Redfin is actually a little worse for the economy in my mind than Compass. And this is why. Most of the Redfin agents are employed. Most of the Compass people are independent contractors like me. Okay, so Redfin, you're actually being paid by Redfin to be an agent, and you're getting a salary, usually with health benefits, and you make a little tiny bonus every time you close a deal. It's disgusting if you're a realtor that way. But it's like a regular, it isn't a 9-to-5 job, but it's a regular salaried job. So when they cut people off, you're cutting off salaried people, right? People that are making income every week, which I think is more traditional type of, when people think of layoffs, that's what they think of, not independent contractors, laying off. So now we have the real estate company, we have the mortgage companies, right? Title companies are going to be coming next. And this is why. And it's already happening, okay? But title companies are going to start going down because you can't have 25% less sales every month, which is what we had last month. We had 25% sales in the month before. And the month before that, we were down. I think we've been down for 6 months in a row is the amount of sales every month. Okay. So less sales, less business, less title companies, less real estate agents, less mortgage people. It's just a function of the market, right? So we're seeing all that happening now. So what is that saying? Layoff, right? So right now we're at 3.6% unemployment. The thing that's going to be interesting about this is that good unemployment rate, a healthy unemployment rate, according to the National Economist, is about 4% to 4.5%. Anything under that, it's not good for the economy. We're already have an unhealthy unemployment rate. So the first part of the unemployment, the first part of layoffs are just getting back to a healthy unemployment rate. But what's going to happen here, it's very clear to me. I mean, it's so clear. The idea that the politicians are saying we're not going to go through this recession and that there's still a chance for the soft landing, that's laughable. And I'm not talking about politics here, guys. I'm not talking about red or blue. It's just economic facts. There's no way that we're going to have this amazing soft landing. It would have to be a miracle on top of a miracle.
Yeah, I agree.
For that to happen. Now, I don't know how long the recession could be. Recessions can last as little as 8 months. Right? We might not be talking about the longest recession ever.
Well, and recession always is such a, it's almost,
it's a broad.
We have recessions, I think, on average, like every 5 years. I mean, it's kind of part of the financial flow of our economy, but it always feels like there's such a negative connotation. I know it's not positive, but it's part of the flow. Like it's a give and take. It's part of the way it rolls.
The scary part. Oh, go ahead, Jarrett.
No, I'm saying it has to reset. It's like a reset almost back to the right values. But what is a recession? What are we calling a recession? There's different definitions of a recession. I know there's economic definitions. What are you considering a recession?
The recession is the slowdown, a combination of the slowdown of the gross domestic product
Right.
the stock market.
Yeah.
Okay. And there's
unemployment.
another factor I think that another big. I'm sorry. Go ahead.
Unemployment, right?
Unemployment. Yeah, unemployment rate.
Yeah.
So here's what I expect to happen is at first there's going to be these layoffs, and at first it isn't going to look so bad because we need the extra. We need the extra people.
That's going to help on Jarrett, what he was saying about the small business employers. Like, I can't find good people because they're just going to go somewhere else. Like, there's jobs aplenty, so they don't want to do what we're doing. They don't want to work hard. They'll say, I'll go over here and get paid. So that's
I call it the Elon Musk attitude. Did you see what I'm a big fan of Elon Musk as far as he's a very interesting guy, right? So Elon, he came out just recently saying on Twitter that, or he put out an email out to all of his employees saying, if you're not willing to come back and physically work and actually work for a living, he basically said, if you're not willing to come in and put a 40-hour week and actually drive to the office, don't come back anymore. See you later. And everybody got mad at him. And I
thought it was weird. It seems kind of out of touch because I feel like the home employee has come a long way and is productive.
The guy works 120 hours a week. He's an animal, so he expects everybody to work at 120 hours a week. He sleeps on the floor of the Tesla factory. A billionaire sleeping on the floor of Tesla factory. I love this guy.
Is that a fact? Like, for real, he does that? Or
I think he has done that.
Yes.
I mean, I've slept at my office too.
He literally would sleep in his sleeping bag during the production line when they were having problems back in the day.
Yeah.
I sleep in my office every day.
Yeah.
Yeah, your office has a really nice kitchen, Mike. So wait, but there's more cracks I need to tell you about. Okay,
there's more.
There's more. Just to let you know that what you're reading about and stuff is so smoke and mirrors, guys. Okay. Yeah. Now here's the next thing.
I'm waiting for the political cycle to tell me what the recession is, right?
Well, do you remember Bush? My favorite line about the economy ever, my most favorite line about the economy was when Bush came out and said, the fundamentals of our economy are strong, in a State of the Union address. And like 3 weeks later, Lehman Brothers disappears and we don't know we have a banking system anymore. Right? I was like, yeah. And I'm not picking on Bush because you know what? Biden's doing the same thing right now. Yeah. He's as bad as what Bush is doing right now. When he went on TV a couple of days ago, what was it, 2 days ago or yesterday, where he had the big conference about, what did he said? Everybody's feeling really, really down. I think that was the quote or something. Of course, everybody's really, really down. Things are not looking good for the economy right now, but they can't say that to you because the problem is the economist said the reason why we had stagflation back in the late 70s to the early 80s was because people expected inflation. So expectation actually fuels inflation. I would love to know the psychology behind that, but it's an accepted fact from economists across all political persuasions that if you think you're going to have inflation, you get inflation. Isn't that wild?
Yeah,
I think that's wild. I find that fascinating.
I guarantee there's somebody out there that's going to throw in like that. What's the word? Something doesn't equal causation. What am I trying to say? Shit, I should have thought.
Well, let me just say this other crack. Here's the other crack. Talk to four Airbnb. Sorry, Mike. I talked to 4 Airbnbers. Okay, West Palm and St. Augustine, Vero Beach. They're all multiple. Vero Beach, and then I know another person up in Fayetteville, North Carolina. Okay,
correlation.
All 4 of them don't know each other. They all told me about the same thing. Their booking rates are down about 40%, 40% compared to last year. And they're all starting to freak out a little bit. And there's 2 reasons for it. Okay. Number 1,
competition.
The people in Fayetteville, when they started doing their Airbnbs, there were only 200 Airbnbs available in Fayetteville. Now there's 600.
Prices for forecasts were based on historical prices before there was all these Airbnbs. So all their projections are way off.
Jarrett told me about a month and a half ago, if I ever work with his customers and we do Airbnbs, he says, I'll only approve it. This is cool. He did this. He goes, I'll only approve it if the numbers work as a regular rental.
Yeah.
And then if they want to Airbnb it, let them go ahead and do that, because Jarrett's trying to protect them for the vagaries of the market. But here's the problem. There's too many people that bought Airbnbs for Airbnb rates.
Yeah.
And how much money they're going to make off of that, and not regular rental rates. And Airbnb rates, if you have good, oh, by the way, 40% less occupancy rate. Their normal rate was between 75 and 85% of the month it was rented out. Okay, so it was rented out a lot, all these places. Okay,
But
they were like
there's
real.
more of them now.
They're all super hosts. All these Airbnbs I talked to are super hosts, so they know what they're doing. Okay, and they had 75 to 85% occupancy. Now it's 40% down from that. Now they're worried that so I think there's two reasons for that. Number one is competition. The market's flooded with Airbnb, so you got to be the best one at the best price. But I also think it's another thing. Gas is $5 a gallon.
Yeah.
And I think this summer is either going to be the last hurrah.
It could have. Transportation was the other thing that would hurt.
And so you're not going to be you don't want to drive to your the Airbnb places and everything. And you're probably, if you're worried about money, what's one of the first things you're going to cut back? I think travel,
streaming.
Right? Don't you think? Don't you think travel will be high on the list?
I think people are willing to spend money they don't have to go do that trip because they deserve it. They work hard. They haven't done anything for 2 years. I don't think we're there yet. I really don't. I think the only reason that number's down for those folks is competition.
I don't agree with that, but you might be. But I don't have any facts.
I don't think America in general has proven at all that they are not willing to overspend.
Johnny, I hear 100% what you're saying, and I think you could possibly be right too. But the flight prices have gone up drastically.
Do you see how many flights have been canceled? How many people are stranded? People are still buying those tickets at probably 3-4 times what it should be for sure.
Yeah, and we don't know the statistics on how many are for work or business, but I think at some point that'll be part of it. But I agree with you. I think America has no problem overspending.
This summer is going to be hot and heavy. It's just going to be burning up, baby.
Everybody
will bitch about the gas.
Well, if that happens, Johnny, then that's it. Because if that happens, that's what I was going to say. Either this summer is going to be the last hurrah, or last summer was, and I'm not sure.
The only way people change their habits is if they get burned. Then they're going to get crushed. They have to. So typically, it's going to be, I can't overspend because I've maxed out my credit limits.
If that happens, then we're going to get stagflation. So if everybody's a dumbass, excuse my language, and everybody just goes nuts and they don't care about their savings or their future, and they just go nuts and just say, I'm going to do it because I want to, then we're definitely going to have stagflation, and that's not going to be fun.
Well, we got a canary in the coal mine. We got a guy that looks at people's credit all the time. We got a couple of them with Jarrett and Mike. You guys see people's spending habits. People that make a lot of money, people that make average dollars. Look, we know what America is. We don't save. We don't live responsibly. And I'm talking about a collective. I was part of that group. Hell, I still am in a lot of ways. My wife has made me much more fiscally responsible, and leadership, like guys like Mike and Jarrett and Jim, to be like, this is the right way to build your future versus I want to live for today. Now, I appreciate living for today. We're not promised tomorrow, right? So you got to enjoy your life, but you guys see it. Have you seen more fiscal responsibility in the last year?
And John, you're right. It was with loaned money. It wasn't even with their money.
Right. We're not talking about their dollars. We're talking about money they can't afford, essentially. Have you seen it? Simple yes or no answer. Are you seeing more fiscal responsibility?
I haven't seen cut back.
What about you, Mike?
We don't just flip that switch as Americans.
Maybe a little bit, to be honest. If I have to be honest, there has been a little bit because they don't have the money. It's starting.
We can't access more credit.
I'll tell you what, so I see a couple of indicators just in my business, Johnny. So I'm looking at people who have obviously overextended, like they got credit card balances that are high. You can tell that they just spend more than they make, and they're not able to save. I got people who are trying to buy a house, and they qualify, but they don't have any money, right? So that tells me.
And you're seeing headlines. You're seeing headlines now where we always knew it. And Mike, I'm sorry to interrupt, but you're seeing headlines on. It might be real clickbaity, but 35% of people that make $100,000 or $250,000, they're living check to check.
Yeah.
Yeah.
Talk
I
about
mean,
living well
there has
above your
always
means.
been that maybe it's an American thing. I don't know how American it is, but the more you make, the more you spend. I mean, that's just how it goes. And leverage is the name of the game for a lot of people, right? They're leveraging credit, they're leveraging
And
their
Mike,
house.
there's a big tool for people to be able to save themselves from these positions with these high interest rate credit cards, with HELOCs and refis. And now with the interest rates going up, I think that's going to cause some interesting situations as well.
Yeah.
Speaking of Johnny's, attitude about the American buyer, if you will, or consumer, right? Remember, Johnny, remember about 2018, I guess, when they were starting to read the Fed rate the first time because they thought inflation was coming, right? So they started raising the Fed rates in 2018, and you and I were talking about on the show all the time. Even though that they felt the economy was doing good, they felt like it was going to start to overheat. They were saying that we had more debt. Remember that? We had more credit card debt per capita than ever before.
Sure.
But by the time COVID hit, we had more savings in bank accounts than ever recorded in the history of the United States for regular homeowners. And I was like, where's not homeowners, but citizens? And I was like, where's the disconnect? How could in 2 years we go from the highest debt ever per capita to most savings per capita ever? How did that happen? And we knew it came from the money. But there was a really good article in the Wall Street Journal a couple of days ago talking about this woman who is now in really bad economic situation. But a year ago, she had $2,200 savings in her bank account. And as she described in the article, that was very good for her. She hadn't had that much savings pre-COVID in the bank. So then it dawned on me, the money, the trillions, they said it was a couple of $1 trillion we had saved, like in our bank accounts, cupboard away. It's spread out to very low amounts to everybody. So everybody has a little bit of savings, it looks like, across the country. And that's how we get to the trillions of dollars saved. But nobody has big bank accounts saved. So you're right, Johnny, it is paycheck to paycheck. So that lady, when things got bad for her, and she was working 3 jobs, the woman's working 3 jobs just to put food on the table, that $2,200 gone. Now it's gone.
Oh, yeah.
And that's what's going to happen. The slower, like you're saying, Johnny, it's going to be, that's why I'm calling it the last hurrah. I think people might just do whatever they're going to do right now. And then they're going to have the economic hangover this fall.
Yep.
And that's where I think that things are going to hit the ground. I'm thinking September, October, November, we're going to be talking about massive layoffs. Like I'm not massive layoffs the way it was COVID. I don't think it's going to be like that. But there's going to be less people buying stuff, which we're already seeing. Here's another crack. So the Airbnbers are slowing down. Here's another crack. Inventory for
property
goods produced are increasing right now. We have all the stuff that even with the supply chain problems, now we have too much stuff in the warehouses for a lot of different products. And now they don't need to make as much of it because they need to sell what they already made. So what do you think is going to happen then? They're going to lay people off because they don't have to make stuff as much.
Here's what we need, guys. We need
reflecting it. A dry. I don't know if you guys saw where it ended on Friday, but we got crushed, right? Like the last couple months with the overall market performance. So it's already showing, So and that's people's bank accounts. That's their savings. That's their retirement plans. That's everything. So
that's the one people are watching. People are watching their retirement instruments and saying, "Holy cow, we had a good 2-3 year run of double-digit increases in your standard mutual fund style, and then all of a sudden maybe you're negative or single-digit increases." You know what we got to do, Jim? We need to do we know anybody like high-level executive at Publix? I'd be curious 2 things. I think number one, the overall spending at Publix is going to go up because people are cutting out, eating out, right? So they're going to be like, okay, now we're at home more. I'd be curious what the percentage of their maybe the Publix brand versus the off brand. So the generic brand spending, instead of getting Cheerios, I'm getting Oreos or whatever, like stuff like that. I'd be curious how many people are buying the less expensive grocery items. They're spending more on groceries, but they're buying the less expensive grocery items compared to the the higher brand, maybe higher quality stuff. That's a good indicator to me.
I have a contact there, or even CBI we could talk to. That's a different. It could show if it's gone up or gone down. But I do know some people at Publix. If you guys want to get them on the show to question.
Just curious, just as like a little like temperature, check the temperature of the economy. What are people spending on groceries, and what are they buying?
So it's very clear to me. It's crystal clear what's going to happen right now. What we're going to see is we're going to start seeing.
Wait. This is a quotable moment. Here's Jimmy's predictions. Ready? And start the camera now. What
we're going to see is we're going to see that the layoffs are going to continue to get higher and higher, and we're going to see the unemployment rate start ticking up. I don't think it's going to be like the last time, but it's going to start like increasing month over month, and we're going to see that. I don't know what's going to happen with the stock market because I'm just not really that great about that stuff. Because to me, a lot of the stuff that happens in the stock market isn't anchored in reality. At least with the real estate market, it's a little more anchored in reality because they have to get loans from other people to get the house they want to buy. So there's some kind of thing. But with stocks, it's stocks and crypto and stuff like that. I know stocks is a little more sound than crypto. But it's the same kind of thing to me in a way. It's more conceptual than real.
Yeah, Jim, what's going to happen with crypto over the coming 18 months?
Stocks.
Yeah. I don't know. I couldn't, so one of my friends, Lee, who's one of our good customers, he tells me that he heard that crypto is going to get down to 9,000. We're at 19 last night. It was the first time we've been under 20 since
talking about Bitcoin specifically.
Bitcoin specifically, yeah. And that's the first time it's been under 20 since the COVID, since like May 2020 in 2 years. But it also
everybody that's predicted the decline of Bitcoin, they just kind of reset it every couple of years. They're like, it's coming this year, it's coming, and just keep kicking the can. You might get right eventually.
And the other thing is the 5.78 Freddie Mac interest rate this week. That puts us back to 1987. That's the last time that Freddie Mac had an interest rate 5.78 is 1987. When was 1987? Right after we got out of that stagflation.
Who won the Super Bowl in '87, Johnny?
I'm going to say
Bengals.
Broncos?
What?
49ers.
Bengals have never won a Super Bowl, Jarrett, ever.
Wasn't it the Washington? Wasn't it the Doug Williams? Maybe I'm
87?
wrong.
Yeah,
maybe
did they beat the Broncos? Maybe.
Let's see.
I feel like maybe the Broncos. Maybe they lost to the Redskins that year. Did they lose to the Giants that year?
Yeah, I think the Redskins in '87. It might be right.
That feels good. Yeah, Timmy Smith and
Williams.
Monk. Yeah, you might be right.
So Giants beat the Broncos.
It was the Giants.
Giants beat the Broncos. Thank you. So I want to talk about somebody that called up this week that I hadn't talked to since 2014, right? This is going into today's market, just showing you the difference when we started the show in 2012 till today and how things kind of come back, okay? So I had these customers that called from the show. They were in real trouble with their mortgage back in the day. And so we were going to try to short sell the house, and we were also trying to do a loan mod at the same time. Okay. So we were doing the loan mod with Paul Krasker, and I was trying to short sell the house through the short sale innovations. And
so if they could stay, they wanted to say, but if they couldn't get the loan mod, then they were going to sell. Is that?
Yeah, exactly. So what happened was it was September 2013 when they first met me. Okay. And then we were working the short sale, but they ended up getting a loan mod. So they canceled the short sale in 2014, May 2014. And I might have reached out and talked to them through a text or something once or twice over the last 8 years or so. But they called me up and they said, hey, I think it's time for us to sell our house. So went over to take a look at the house. And the house is a really nice house in a good neighborhood. However, it's kind of dated. And what I mean by that, the roof is original. It's a 21-year-old roof. Okay. And they haven't really updated the bathrooms. While the house is nice and everything, they haven't really updated the bathrooms or the kitchen. And there's some deferred maintenance issues in the house to make it really sweet. And the backyard pool, while it's awesome and they have a really good yard, But while the backyard pool is really, really nice, to refinish it, because the pool's so old, with the tile coping and the coping stoves and all that, and then refinishing it, it's like a 20 grand job. So there's a lot of expenses in this house to do. So when they met with me, now you got to remember, back in the day, I tried to sell their house for 300. Nobody wanted to buy it. We dropped it to 250. Nobody wanted to buy it. And now I'm coming to look at the house today. And the house, I believe, is definitely in the mid sixes.
Boom.
Yes, in the mid sixes, right? Which is awesome. It made me feel so good, because I was like, I helped them save their house. They wanted to stay there. We helped them save their house. And here it is 8 years later. And now the house is worth $400,000 as it sits. It's worth $400,000 more than when they came to me when they were in trouble.
Beautiful.
And they got the low
when they
mod.
bought it.
They got principal reduction too through Paul
Wow.
Krasker. Yeah. So
What they paid for it when they bought it, Jim?
I don't remember. I don't know. I think they might have built it, so I don't even remember. I think it was in the 170s or something, I think.
Oh.
So here's the thing. I told them that probably mid sixes to low sevens. Now, if the house was completely fixed up, super Mac Daddy, brand new kitchen, brand new bathrooms, brand new paint, brand new roof, air conditioning's good already, pool resurface, the house brand new, just really tidied up. That house would probably be in the eights, right? Mid eights. But in order to make it like that, you're going to have to put on a new roof, new kitchen, 3 new bathrooms. Okay. Flooring probably have to be updated, paint inside, outside, work on the pool. That would be the minimum, right? You're easily talking $125,000 to $175,000. And if you add that money to what they could sell it for now as it sits, if you add the two numbers, it comes out to like the mid eights. But you have to go through all that work, and you don't know if you're going to make that money or not. And how long is it going to take you to do that in this shifting market? And our price is going to start going down. And by the time you're done with the construction, the house isn't worth $850 anymore. It's only worth $775. And then you're smacking your head going, why did I even do this? I should have just sold it for the mid sixes.
That's what we were talking about with that 1031 exchange scenario. Is it even worth her renting her house for the next year? She'd save an exorbitant amount of taxes, but with that type of property in a year, the price could change and it could be worth less than the tax savings she would have got.
And
so it's a really tough question. And
I really think that if you had a bet, I would tell people to expect a 10% to 15% scale back in equity of your house, because I think all the profit that we made, or all the equity increase that we made over the last year, that's gone.
Wait a minute. Hold on. Real quick. That's a huge shift from conversation we just had like 2 weeks ago. 2 weeks ago, we were saying that we're going to see a slowdown in our equity growth, right?
Mm-hmm.
So we've seen
exactly.
So just 2 weeks ago, we're all pretty well settled on. We'll see about a 4% increase in people's equity in the next year. Now it sounds like you just said 10% pullback.
Yes, yeah. And when we were talking about the 4% growth, we did hedge it. I'm being honest with you about that, because I said this is what the national economists are saying, that the demand is so great and the inventory is so tight that even as the interest rates go up, while prices are going to flatten, they're not going to go down. That's what they were saying. Okay. But that was the time 3 weeks ago or 2 weeks ago, because we've been saying that for about a month now, Johnny, maybe even longer.
It's just last week we had the first signs of the tightening, right?
I know, but the thing is that all the economists kept saying that we're going to have this soft landing. And I've been saying, I don't, I hope it's true, but I don't see how it's going to happen. But now I don't see it happening. I also going to be surprised. I wouldn't be surprised if next month, instead of a 0.5 point increase at the next meeting in July, I think it's going to be a 0.25 point. And you know why? I think they're going to be in shock of what's happened. What they've already done is like, holy smokes,
Because
everything's changing so fast. Maybe we need to put the brakes on this a little bit.
So QT is quantitative tightening for those that don't know, versus QE, which is what we've been in for the last, I don't know what,
8 years.
What's QF, Johnny?
Put it in the chat here for you. So the QT that they're doing right now, it's rapid because they're quote unquote trying to fight inflation. And I use air quotes because I think it's kind of a mockery to the intelligence of even the layman. But ultimately, like, we should have been doing this for 6 years easy, slowly doing the QT. Now we get to the point where they're like, oh my God, we're teetering. And it's all about the housing market. Let's face facts. We're teetering. And so they ratchet up the QT, and with the sell for America, like, oh, it's for inflation, even though inflation is global and it's more, there's so much corporate greed tied into this. It's unbelievable. Like, we're not going to address the real issues at play here. We're going to try to smoke and mirror it every step of the way. So, Jim, you might be right. The soft landing might be tough because of the shell game they're trying to play.
It's not happening. It's not going to happen.
I think we can, and I think they might because of the structure that we're in, the way that we're starting to see the channels open up globally for, just the ability to get things out. As you say, we're starting to see things now backed up in a warehouse, right? So that means
layoffs, Johnny. Once they start laying off, everybody's living paycheck to paycheck.
I think it's all gonna hinge on consumer spending. If consumer spending stops, then that's
going to be layoffs.
You better hope Americans hang on to that.
But before the consumers stop spending, it's going to be layoffs, Johnny. That's what I'm trying to tell you. The first sign isn't going to be consumer spending. The first sign is going to be layoffs. Why are they going to stop spending? Because they don't have any money. So the layoffs will happen first, and then the consumer spending is going to slow down. And then what's going to happen is
layoffs are imminent in certain sectors.
So what's going to happen is that we're going to see the layoffs. We're already seeing it right now. Then you're going to say, hey, people aren't buying stuff. Then you're going to hear people aren't buying stuff as much. Then you're going to hear the companies laying people off more. And it's going to be like a self-fulfilling prophecy. Less people buying, less jobs needed.
Well, that's what I just said. If Americans stop spending, we're screwed. But I think the layoffs are happening in specific industries right now, and
because you got to start somewhere.
The tech industry is too frothy. They overstepped, and even the ones in like the real estate market, it was just an overstep. Everybody thought that the market was going to run hot and heavy forever, so they just brought on all this extra crew. The reality is I think everybody on the show knew it wasn't going to last forever because you've been in real estate.
Look, if we lose 10% of equity, we really didn't do that bad. We had a 10-year run. And people forget about that. We had price appreciation in the last year was so ridiculous. It wasn't based on anything other than lack of inventory. If the inventory wasn't so crazy.
If we lose 10% on our equity in the next year, that is such a pulling of the veil to show you Oz, to be like, none of it's real.
Well, it was just like the last crash we had, Johnny. The last crash in 2006, it took us until 2019 to get back to 2006 numbers because 2006 was bull. So this isn't like the first time this is ever going to happen. It's happened before.
It won't be the last again.
And it won't be the last. You're right. Because that's the way the economy goes. It goes, it gets up, it's down. They try to build it up. It gets too hot. They do stuff to bring it back down. It gets down too low. They got to do it again. That's just the cycle of life. So
we can never lose sight that part of the crash before was consumer sentiment when they lost major value in the home. Mm-hmm. This was the first time ever people were just like, we're just going to default on our loan, right? Like either they had to or they chose to. Like, hey, we're just not going to make our mortgage. And all of a sudden, mortgages became this super stable investment to, the whole game, right? With the A-rated and B-rated C and whatever, all of those things. So I don't see that part of it happening on this cycle where people just are going to stop making their mortgage payments en masse. Right, like across the country, everyone stops.
Well, if they don't have the money in the bank, if they're really living paycheck to paycheck, and we have layoffs, and we have more layoffs than jobs to be filled, people are gonna have to make a big decision. How am I going to save my house? Because there's equity. Most of them have a ton of equity, so they're going to say, Should I sell my house, take out my equity now, go rent for a while, lick my wounds, get a job? Because a lot of people could actually probably pay a year or 2 years rent off the equity of their house if they had to.
If
right?
they sold it, yeah.
If they sold it, and that's going to be a tough decision. I'm not saying I want people to do that. I'm not saying that. But I'm saying these are the decisions that people are going to have to make when unemployment comes.
I think losing that safety net of being able to refinance the debt and the mortgage, you didn't lose it, but it's all now subject to this rate that's not that great, is going to cause a lot of problems, because that's what was digging a lot of people out. You know, it was by taking their credit card debt, dumping it into their mortgage over a longer term at a way lower interest rate. Now they're saving, you know,
I did a ton of loans that were not cash out refis. They were just straight up rate and term refi. Let me get into a lower interest rate, and I'll extend my mortgage because I want the low payment and the low interest rate.
Right.
And that's because I want to be able to save. And so there was a lot of that happening. People
that's exactly, and that's even more of that's not going to happen. Obviously, most people
can't now, but people did do that, right? So people
and that was awesome.
That
was awesome when they did that. I think
maybe people were mentally preparing to weather whatever storm this. Jim, you're talking about a soft landing. It's not going to be there. The opposite of that, of course, is a hard crash. There's some middle ground there, right? That's
what I'm saying. This could be an 8-month, 12-month recession, and then it's gone, and it just sucks for 8 months, and then we're back to normal and we're climbing up again. That could happen. I'm not saying we're going to go through the crash.
If you can't give it a name, it's never going to stick. So is it like a belly slide, broken wheels off type of thing, but it doesn't go up in flames? Like, what do you call that?
Cartwheel.
Oh yeah, I see. Like instead of a soft landing,
parachute landing.
Yeah, exactly.
What soft landing? I don't know.
It's like the old school, like airborne, like they drop down like a sack of brick, and they break their legs. But if you do it right, you can kind of roll out of it type of landing.
Yeah, I think it just means that we can come back from it a lot, quicker, right, Jim? Isn't that what you're saying?
I think the real estate market, in my opinion, needed to have a reset for quite a while now, and I haven't liked this market. I've said so. I was just talking to a seasoned realtor who's like been doing this 15 or 20 years longer than me. And she was like, I'm so tired of this market too. And it hasn't been horrible to be a realtor in this market. It's actually been pretty good, but it's not a fun market because one side's got it over the other side. It's like a little league player, meaning a buyer playing against an NFL football player. That's what it feels like. And the football player is the seller, right? And it's been like that. But now with the interest rates changing, here's another sign that the economy and the real estate market is changing. And we're going to see the price drops I'm talking about. We're seeing more actives back on market and more active price reduced than I've ever seen in a very, very long time. Not since 2018. And you know what was happening in 2018? We were raising the Fed Reserve rate and we got to 4.94. Right in 2018. That was the highest rate, 4.94. And we started seeing price reductions in back on markets. We're seeing more of those. 5 of the last deals that I worked on, buyers and sellers, 4 of them didn't appraise.
Now,
I haven't had issues like that in so long. I've been dealing with valuation disputes for the last month and a half because the prices are changing so much.
Yeah, it's hard to. Yeah.
By the way, Johnny, I have to talk about your neighborhood because that house didn't appraise, but we got a good,
surprised.
But we got a really good price for it compared to your house. We did excellent over there, and your house is worth a lot more. So anyway, I just want to tell you, at least Jim, now, at least today, at least today it is. Go ahead, Jarrett.
Do you think it's going to be different for properties out west as opposed to properties in the middle of the cities or properties on intracoastal or oceanfront?
Yes.
Like is the oceanfront and intercoastal market going to continue to go up because of the limited inventory? It's hard for me to think inventory's, so tight, but the prices are coming down. Like I get it that the rates are going up, but some of these people have the cash, right? Like that are buying certain properties.
You're going to start, my prediction is you're going to start seeing the inventory creeping up. I bet you next month and the next month's report for the MLS or the Realtors Board of the Palm Beaches or whatever. It's going to show that our days on market have increased And it's also going to show that our inventory is increasing, but it might not be because the number of houses going on the market are increasing. We might have very close to the same amount of houses for sale, but less people are buying them, which is going to mean inventory is increasing without the numbers going up.
Yeah.
So we're going to be in a very weird, awkward teenage stage. But when you're talking about will certain markets like the oceanfront market or intercoastal market be insulated from this? The short answer is, I'll tell you my opinion. It's just opinion.
Here comes the no, Jarrett. Here comes the no.
But the thing is I don't know. The question is I really don't know. I don't know if that market is going to get weak or not. But I am going to tell you this. What I'm talking about now, it sounds a little more gloomy or doomier. We're going to be going through some very choppy water, right? And it depends on your personal situation, whether you're going to do better or worse in this market, because there's some neighborhoods that are still going to be doing very well for desirability, and you're still going to have bidding wars, and other houses are going to be sitting there with crickets chirping. And we're already seeing the crickets chirping, right? So it's going to be there's going to be two things involved. Number one, how desirable is the location, and what kind of value, if the location's good, what kind of value are you offering to the buyer compared to your competition in that location? It isn't just going to be, the whole market is tight on inventory. Anybody will buy anything. It isn't going to be like that anymore. It's going to be block by block, street by street, house by house. And you really got to look at the value you're offering in order to get the house sold.
I would think, Jim, just like it's natural, what you just said, notwithstanding, right? Every individual house is going to be different. But I would say just the general level, neighborhood by neighborhood, is going to be up and down the same, right? So proportionally, like if this is the difference between the price in this neighborhood and this neighborhood, these things are going to be like moving like up and down together, right?
I don't think it will be like that. I think it's going to be different. And I think the luxury market's going to reflect differently than the rest of the market, I think. Now, Jarrett,
that should bode well for South Florida. I mean, we just happen to be in an area where
wait a second. There's articles in the Sun Sentinel right now that's saying the luxury sales market, the amount of sales, not the prices, but the amount of sales has been down 4 months in a row.
Whoa.
So yeah, and exactly. That's what I'm saying. People don't really understand this market. A lot of people think they know the market, but they don't read all the stats on everything. So they have a lot of perceptions that aren't really based in that reality anymore. Go ahead, Johnny.
But that's not uniquely luxury market. That's like across the board, isn't it? Haven't we seen less and less?
Well, the luxury market was, there's so much going on with the luxury market. I'm going to be creating a video
right now. I didn't expect to hear that stat, I think is what Jim's saying.
4 months in a row, the sales have...
saying like, you think prices are going up still? Well, the sales have gone down over the past 4 months.
But the prices really have held okay. But the sales, the number of sales have gone down, right? So here's the thing with this is, I'm going to be doing a video just talking about understanding taxes in Florida, because the people up north, they handle their property taxes and the sales tax and the income tax and everything differently than Florida. So a lot of people don't understand how taxes work down here. And I'm going to be doing a video on that. I'm going to be doing that video for luxury buyers. Why? Those people still, a lot of them are cash. They can come down here if they want to, right? And then it's just going to depend on what they want to buy and how much they want to spend. That's what's going to determine if our luxury market's going to stay strong or not strong, is how well like the northerners or the people coming from out of area are willing to come down here. We still have a lot of people saying, I'm tired of the COVID laws. Florida's more free about that. I'm tired of paying state income tax. I'm tired of being taxed on everything. I'm tired of having big government on my back. Let's go to Florida. It's the Wild West out there, right? Comparatively. And if there's still tons of people like that, then that market's going to stay very strong. But I don't know. I don't know what's going to happen up there. I'm already hearing from a luxury agent up in New Jersey. I'm working with a client up in New Jersey right now, luxury, $1 million plus home. And she's saying that the New Jersey market is slowing down fast right now. I mean, super fast.
Yep.
So we'll see. So if it's slowing down fast up there, does that mean that they're not going to be buying down here because their house up there isn't selling as fast as it was a year ago?
Yes.
Yeah.
So
Yes.
that could affect the market, and that's why this is so fun to be in real estate. To me, this is fun watching these changes. But if you need to do real estate, you need to have people that understand the market the way that all of us do here at the One Stop Real Estate Shop.
Yeah,
to give you the best advice.
FloridaTalkRealEstate.com. That's FloridaTalkRealEstate.com, your one-stop real estate shop. Your access to the entire team. Know it, use it, love it, share it. Again, you got a team of pros, and you can find them all at FloridaTalkRealEstate.com. You'll see the hotline there. You can call it anytime. Of course, there's a contact sheet you can fill out. You can always reach out on Facebook as well, Florida Talk Real Estate. And remember, YouTube, Florida Talk Real Estate LLC. Jim was just talking about making a video about the luxury market and tax implications. And of course, with the wealth and knowledge you get from Jarrett, that is going to be a very informative video. Again, FloridaTalkRealEstate.com on Facebook and YouTube as well. Can I ask a question about positioning for folks? So, Jim, in 2021, a lot of people maybe listening right now or not got phone calls from me about their future plans. And, so many people were like, well, I want to see where the market goes. I want to see if I sell now. And every one of those conversations, it was, okay, but you got to be mindful of the interest rates, because as the market's going to change, your rates are only going to go up. And they're always like, yeah. Like they fluff that off. Not all, but it was pretty common to be like, I think we'll be good. And so many are now priced out, as you highlighted earlier. When you lose 10% of your buying power, Mike highlighted, with 1% interest rate increase, you're doing a $400,000 home budgeted at whatever your number is, say $2,000 a month. You're now at $2,000 a month. You're now in a $300,000 home. All things being equal, you've lost that much of your buying power. So what people can do to kind of position themselves again, look, any kind of cash you can put down, beautiful, 20%, 30, the more the better. Michael would to have conversations with you about whether you should use your cash or other people's cash, and those are very valuable conversations. But Mike, as far as putting yourself in a position, when it comes to second incomes, second jobs, explain to me quickly, and I know there's a lot of people out there that might have the same question. What are the qualifications I need to meet in order to account for that income for a qualification on a mortgage? And I'm talking about picking up a second, maybe third gig, whether it's a delivery gig, a full-time gig. How can I qualify that income, and what kind of timeline do I have? How does that work for somebody who's thinking, I got to get a little more income in order to get back to my qualification of the house I want?
You're talking about W-2, I'm assuming, right? Like not like you start a self-employed.
Well, that's it. That's what I need Mike to explain. Like, how is that going to work? If I got a business idea, I'm thinking about starting a business, but as self-employed, like, how long do I got to wait? If I start my business, Handies for Gas, I start that tomorrow.
What is it?
Handies for Gas.
I like that.
Handyman service.
I thought it was for the handicap.
No, it's a handyman service. A lot of people need handymans. Handies for Gas. Jimothy, that's my idea. Do not take that. If I do that, how long do I got to wait? Okay. If it's W-2, like, who's in a better position, and where how do I make that work?
So it's actually, in this case, it's the same answer for both scenarios. So if you were self-employed, you have to have 2 years of tax returns in order to calculate your income. So your tax return is very important for calculating income, but you need a 2-year history of doing it. As it relates to second jobs or seasonal jobs, so you have your primary employment, then you have this second job, you're working night shift or whatever. You need 2 years of working 2 jobs in order to count that second income. All right. So you have to have 2 years of doing that as your thing in order for us to count that second job.
And that's it's typically more than 2 years, right? Because they have to have 2 years of tax returns.
Oh, so for the self-employed, you have to have 2 filed tax returns. That's how we're going to calculate your income. So you may have been doing this, Johnny, for 2 years, but if you haven't filed 2 returns, it doesn't count.
Gotcha.
Right. So you kind of have to wait till you have 2 filed returns. And of course, the returns tell you the story of your income. And many people, like your first year of doing handies for gas, you might not do so well. Right. Like, so it's kind of a little game you might have to play. But I think the second job one is critical, because most people think I need to have as much income as possible when I'm qualifying, which I agree with, right? And it's not because I want you to max out or go overspend, but I want the more income, the better for me. Right. So I want you and your spouse, right? I want, if you need a cosigner, like if I have more income,
The most
that
income,
helps
the less
with
debt, right? Those are beautiful scenarios.
Yeah, of course. And it's just,
the
just
more
so you have the
tax
most
flow,
options.
obviously, right?
Yeah.
So
Yeah.
kind
But
of like a fine line. That's what Mike and I talk about. That's why it's good to get an idea. But, you know, if it's a couple of years down the road, the interest rates are going to be changing and all that stuff. But, you know, it may be good to maybe not show, you know,
but there's
some expenses that could be borderline, for instance. So you're not over expensing items or something like that. You know, there's certain items that qualify if we report them a certain way, like business mileage. If you pay, you pay your car payment out of your business bank account, even though it has nothing to do with on your tax return, you take a business mileage tax deduction. As long as the car is paid out of your business account, it doesn't hurt you for mortgage purposes. It gets
or you can basically kind of that car payment is probably one of your big monthly expenses, and so if you can show that it's a business expense demonstrated by the business paying for it and business expense on your tax return, and these are all like just general self-employed rules of the road. If you're trying to qualify for a mortgage, you need to be cognizant and you need to be working with professionals who understand, like maybe even if it's just this year and next year, how can I maximize my qualifying income for a mortgage perspective? And that applies not specifically to Johnny's question, but just any self-employed borrower, whether it's your primary, second, or whatever. But I think to your point, Johnny, you're not going to be able to just go get that second job, work a night shift at the gas station and say, hey, now I make an additional, 20 grand a year. You have to have history of doing that or it's not going to be counted.
So it's really,
W-2, how long is it, Mike?
So if it's a second job, it's 2 years. Now, if it's a primary, and it's W-2,
it doesn't matter.
Yeah, even if it's W-2 salary position, it's simply you got to have 2 years of doing the two jobs.
Got it.
Right? Like you can't just have it temporary. You got to show some history. Like, hey, I am a person who's able to work 85 hours a week. Right? Like I can do that consistently, and I can show that via my history of doing it. So it's pretty strict when it comes to that. Now, if you get a regular, primary job, W-2 salary, you can use that money immediately. Right, Johnny, you go out and get a new job making 125 grand a year. I'm going to be able to use that immediately.
I can't take a pay cut like that. I just can't. And always a misconception around this too. I've heard this one forever and ever and ever. Just like if you ask a cop or if somebody's selling you weed, if you ask them if they're a cop, you have to tell them, right?
Yeah.
They lie. Because what I always heard, if you change jobs, you had to have a year before you could count it. It's not true. You just said if it's salaried or W-2, like you count it immediately if you change jobs. Like you're boom.
Yes, that's a common misconception. I actually hear people say 2 years, right? You got to have 2 years on the job in order to count it. So that's definitely not the case. The good thing is you really don't have to know all of this stuff. You just have to know somebody who does know this stuff. Right. So the best advice I can give is, hey, when it comes to qualifying income for a mortgage, you should have a real estate agent who knows a good lender, right? Or you should be a consumer who knows a good lender. Say, listen, I don't know, just talk to Mike, right? Call Mike. He's going to tell you exactly what you need to know as far as
how. FloridaTalkRealestate.com, y'all.
Yeah, or that. Just FloridaTalkRealestate.com.
I've said that
you get any of us
many times to people. I don't know. I'm not the mortgage guy. You got to talk to Mike, right?
You're gonna talk to Mike.
Speaking of the same vein as Johnny was talking about just trying to save when you're trying to do a loan. We've never, ever, I don't think ever in the 10 years we've talked about adjustable rate mortgages because they really weren't necessary. Back in when we started during the crisis, it was ridiculous to have an adjustable rate. And then the interest rates started dropping so low that there was no need for adjustable mortgage rate. But I was talking to a friend of mine recently who said that when they bought their first house, 30 years, 40 years ago, the interest rates were so high. This is during that 13% to 18% interest rate cycle that they went ahead and got an adjustable rate mortgage at that time. Is there any benefits of adjustable rate? How do they work, Mike? It's also called an ARM, adjustable rate mortgage. Mm-hmm. Can you explain how they work, and are there any benefits? Are you seeing people applying for them now compared to before?
Okay, so yeah, I would say that there is more talk about ARMs in the market right now. Lenders kind of nationally are pushing like, hey, here's an option to maybe keep your payment affordable, right? So you can get into a payment that you can make if you're not qualifying on the fixed rate or 30-year fixed rate, whatever. Um, Going back to like why we haven't talked about it, Jim. So one of those exotic loans that got people in trouble were things that had adjustable rates, right? They had a very low fixed payment for the first, 1 or 2 years, and then it would adjust, and then all of a sudden you're getting a 2-point adjustment on your interest rate, and your payment goes up, and it's fully amortized. And so these exotic loans, which included adjustable rate mortgages, were part of the problem before. And so from about 2012 forward, right when the show started, there was simply no appetite in the loan market, the secondary market for these products because they were not reliably profitable for in the lending world, right, as a mortgage-backed security. And so even though they have always been around kind of in the non-conforming world, the idea in the non-conforming world is people get into these adjustable rate mortgages and then they refinance into a fixed rate when they can, right? And so these loans would perform for a few years, they get their profit in that few year period, but they're not really thinking long term, I'm going to be servicing this loan for 30 years, right? In the portfolio world, the non-conforming world. So they are coming back as an option. The benefit is twofold. Number one, you can get a little bit lower interest rate than you would on a fixed rate product, at least initially, right? That's part of the thing. You would have, say, on a, this is interesting, call it like a 5-6, right? You might be used to like a 5-1, right? Where it's fixed for the first 5 years, then it will adjust once a year, right? For the remainder of the 25 years on that loan, right? So a fixed rate for the first 5 years, and then you get an adjustable rate and it adjusts every year for the remaining 25 years on the loan.
Can it adjust as a benefit to you? Like, is there a chance it could get good for you?
Yeah. So they start at a floor, like an index, whatever the index rate is that they're choosing for that loan product. Right. It used to be like the LIBOR or whatever. I don't even know what it is right now, but there's an index rate, and then you would tack on, say, 2 percentage points on whatever the index. So if the index were at 4%, then your rate would adjust to 6%. Okay. If the index went up that year, to 4.5, then your next adjustment would be 6 to 6.5, right? So it's something like that. So it's prime plus or an index plus. So yeah, if the index goes down, Johnny, you could have a lower interest rate the next year compared to the current year, right? So that is a potential. I wouldn't ever count on that happening.
How much money are you saving? Like, let's say that right now you're looking at, 6.25%. I'm just making it up. Like, let's say a 30-year fixed mortgage is 6.25%. Forget about the PMI, right?
Last time I looked at it for somebody, Jim, it is not anything that you would be interested in. I was maybe like 3/8 of a point better, right? So if it was 6%, maybe it's 5.625, right, as your starting rate on your arm.
So that doesn't sound like very good risk benefit, because you're not saving that much, but you're taking a risk of the future if you don't know what the heck's going to happen.
That's right. Yeah. And so if you would see a big gap there, right, a big gap would indicate, hey, these loans are, there's an appetite for these loans in the secondary market, right? These are profitable loans. So there's going to be a bigger piece of the pie.
The reason why they're so close right now is they don't.
The secondary market just doesn't want them.
Stomach for
they just don't want them. Yeah, it's not going to be a long-term profitable thing. So if you start seeing that gap widen, then that's going to be an indicator that, okay, this is maybe an indicator that these loans are going to perform, and then they're going to be refi, right? So when you have a rising interest rate market, and the people with the very long game, if they're saying, hey, ARMs aren't, we don't want a big piece of ARMs, right? That's because we don't think they're going to be refinanceable, right? So they're saying rates aren't going to be dipping here in the next, X amount of years. Now, if you start to see the ARM gap getting bigger, and all of a sudden you got a 1-point difference, then that could be a little predictor, like, hey, wait a second, they actually think these ARMs are going to refinance, or they're going to be refinanceable in the coming years. And so it's, you could try and play that prediction game, and that to me it would be a good indicator of it. But I think the benefit, Jim, is the interest rate, and then also you still may have some teaser type payments scenarios, like, hey, it's
Yeah, but
interest
that-
only for the first year, 2 years, or whatever.
Those teaser rates are the thing that scares me the most, because
Well-
that's how everybody got in trouble last time, because everybody thought the teaser rate, oh, this is awesome, and they didn't. They were told, but most of the time, but didn't listen.
One
could
key
happen.
difference there is that teaser rate used to be the qualifying rate. Like, hey, you could, as long as you have your debt to income to qualify for this intro payment, you can do it. That's no longer. You still have to qualify for the fully amortized payment at whatever the rate, the starting rate was going to be. The teaser rate is not a way to bypass qualifying for your loan anymore.
Make me understand how that's a tease, because is it just a lower payment for the first 2 years, because you're not paying off any principal, interest only, right? First year
Yes.
or two. How is the tease there is you're going to pay a little less, but you're not chipping away at principal. So I don't know how the benefits there.
The tease is you can get into this house right now with a payment that you can afford, and then you say, listen, but your job's good, you're probably going to get a raise, right? The home value is going to continue to increase, so you'll be able to do something. You'll be fine when it adjusts, right? Like you'll be fine, right? But now this is the only way you can buy this house with a payment that you can afford.
Gotcha. So it's great, maybe a tool for somebody that's going to buy a jalopy and put some money in, sell it in a year or two, right, and turn a profit. Like, that's a great, valuable tool for their lending for that, right?
I don't know who it's a great tool for. I
Yeah,
don't know. Like, I really don't know. I saw homeowners. Was doing a pre-qual and competing with another lender. They had them in an adjustable rate FHA loan, and I just have never ever seen that in my time doing loans. But it exists. You can do it. And I'm thinking to myself, what the heck are they doing? Do they really need that 1/4 of a point interest savings? And sometimes people get a yes from people in my position, and you can't convince them, right? Like, you can't, like, that's not the best thing for you.
Well, that 1/4 point might be the difference between them qualifying and not.
That's what I was going to say.
be.
Isn't the reason they do it because that's the only way they could qualify for that house a lot of the time? And
That's certainly a possibility. Yep.
Or the right broker saying maybe that's not a reason to qualify.
My advice after talking to hundreds, if not thousands of people during the last crash, if you can't afford it when you're buying it, don't buy it. Save the money and then buy it when you can afford it, and create your plan that way. Because taking the risk, Johnny's like throwing his hands up. It's like, what the heck? You're talking crazy talk, Jim.
So un-American.
It's just, because it's going to get really crazy. And I know I'm going to get more and more phone calls. Oh, I'm going to do a lease option. I'm going to do rent to own. Don't do it. Let me tell you why. You're locking in what you're paying for today. If the prices drop, you're still obligated to pay what you obligated to when the prices were high. And then you're paying more than everybody else, or you lose your deposits. Don't do that. Give us a call.
Are we ready for a commercial break?
Yeah, right. Exactly. Sorry about that, guys. Sorry, Jimothy.
We definitely plowed right out through the internet. I know we did not give the phone number to participate a ton, and that was not because I don't want to hear from you. That's just because the conversation didn't really dictate for a lot of interruption. But always, always, always remember, you have questions, you have comments, concerns, share them. Get the answers to your questions. Get the details that are needed so you can make the best decision for you and your family. Buying a home, selling a home, stuck with a home, you don't know what to do. Maybe you're really needing a lot of tax expertise. You have legal issues. Maybe student loan debt is starting to cripple you. And we have ways to handle all that. Even estate planning. And if you're an athlete and you're looking for a one-stop shop, player performance first. Well, not only athlete, but you're
entertainment
celebrity. You have some talents beyond Johnny C, and you stack dollar bills, and you need a financial future. People to look for your best interest. You can get connected at FloridaTalkRealEstate.com. One-stop real estate shop. You get PPF tied in there too because of Jarrett Perry and of course Jimmy D. Remember it, use it, love it, share it. It's FloridaTalkRealEstate.com on Facebook and YouTube as well. Ton of information to be had. Jarrett Perry, happy Father's Day. Thanks.
Happy Father's Day, man. Happy Father's Day, Mike. Happy Father's Day, Jim.
Happy Father's Day, everybody.
Everybody.
Do we say Happy Juneteenth? Do you say that, or?
Happy Juneteenth. Why not? Happy Juneteenth.
Happy Juneteenth.
It's a new one, so you have to get used to but it's it's that time also. So happy Juneteenth, everybody. Happy Father's Day.
Was a very happy day for those that were like, what? 2 years? Yeah. If you don't know what Juneteenth is, you better look it up and appreciate that day, because that was a sucky couple years for a lot of folks.
Yeah, it was
longer than it should have been, for sure.
Yeah.
Know your history, people. Know your history.
Yep.
Mike Rauch, happy Father's Day. Jimmy D, I know you're not really officially a father, but man, you have fathered along in so many ways. Thank you for all that you do. Have a great weekend.
Thank you, Johnny. You too. Happy Father's Day.
And Jimothy deserves a little Father Day nod as well. Thanks for everything, Jimothy. Thank you for being with us on a Saturday, every Saturday, Florida Talk Real Estate. We'll do it again next Saturday, 9 until 11, 2 hours of infotainment. Locker Room is next. Stick around. Greek, Joe, and Jimothy, they'll take it from here. See you next Saturday. Happy Father's Day and happy Juneteenth. Feels weird. Have a great weekend.